Hey guys, Whitney here. Welcome. I'm so excited for you to join me for today's topic. We are going to discuss how to retire in 5 years or less, or more, right? Like this is just an example plan I'm going to show you today using passive real estate. If you guys don't know me, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com and hope you are ready to learn alongside me today. We are going to cover, as we set up this plan, this model plan of somebody, getting to retirement in 5 years or less. We're going to take a look at the 4 principles of investing that can help hedge investing risk. Very important in today's market. We're going to cover the 3 rules passive investors must abide by to profit in today's environment. Okay, you guys have heard me say this multiple times, the 7 pillars of wealth building, but it's the 4 principles and the 3 rules. We're going to cover those again today, hammer those principles home. And we're going to show you how to collapse time rather than chasing yield. Okay, so, putting together an investing plan where you are reinvesting back into your business consistently and persistently for a few short years so you can collapse time and potentially exit the rat race if you would like. Nobody's saying that you need to quit your job. It's just you're putting yourself in the driver's seat for to choose your own adventure and choose your own destiny. All right, so if you guys don't know me, my name is Whitney again. This is the whole reason why I invest in real estate and why I invest passively. It's for me and my crazy crew here. I started off in 2002 and investing in real estate. Didn't even know I was going to be an investor. I bought a house with a significant other. The relationship fell apart about a month later, and I had a house. And it was in dire need of a rehab, guys. Imagine green shag carpet, psychedelic daisies painted all over the walls. It had not been updated in 40 years. It was pretty scary. So bought the Home Depot 1, 2, 3 book. YouTube didn't exist back then, and I taught myself all things, how to refinish floors, how to do drywall, how to install laminate flooring. It was fun and crazy time. But anyways, the most important lesson is I learned that I could unhook how I created value in the world from how much time I needed to spend on creating that value. And so, in a few short months, I was able to, bring home a very sizable check from the sales of that property, tax-free because of the 121 exclusion. And I had realized that I hadn't been paying for my bills for the past 11 months. My roommates had actually been covering those bills. And I just thought to myself, how many more of these deals can I do? Now, that was a very labor-intensive process. You're probably going, Whitney, I will never do that in my life. I've got a family, I got kids, I am, working my day job. I'm in maybe you're a doctor or a lawyer or a tech worker or a business owner. Like you're already in the thick of it. And I'm not saying start there. I'm just saying that that's where I started and really understood the value of real estate in unhooking how I earned my income, how I could grow my wealth from how much time I actually spent on doing that. And that's really what we're going to be taking a look at today, is visualizing one particular math scenario, on how we could make that happen for ourselves. And I'm going to give you some tools that way you can put together this math problem for yourself and see what it is you need to do to reach those goals. Now, you guys have probably heard my story several times, but we didn't stop at living, flipping, and house hacking. We scaled into buy and hold real estate, and then eventually into passive or institutional grade real estate, actively and passively. Fast forward today, my husband and I, we have over 6,500 residential units in partnership, 2,200 self-storage units. We have several other businesses that we manage on the side, as well as 7 express car washes with yours truly here at PassiveInvesting.com. But those are just numbers, okay? I don't want you to be fixated on those numbers, how many units and all that. That's not the point. The point here, if you're here, you're probably focused on passive investing. The point here is to help you visualize that there is a light, there is a path to where you can have 100% freedom of choice on how you spend your time. Now, I always talk about the 5 freedoms in life. financial freedom, freedom of location, freedom of time, freedom of choice, and freedom to create an impact. And it's really what I want to show you guys is peel back the curtains is no matter where you're at on your investing journey, there you can solve the math problem to understand when you get to buy your time back and have it for yourself. And then you get to choose. I just got off the phone with an investor just right before hopping on this webinar. And she was like, I don't want to leave my job. I love my job. And I'm like, I get it. The whole point is not to lay on the beach and drink Mai Tais. The whole point is to have choices in life on how you spend your time. For me, I love working. I love creating an impact and showing you guys here on how you can do the same in your life. Just think about it. If everybody could be as excited and as passionate about what they were doing during the waking hours, how much awesome, or if that's a word, how much more awesome would this world be? Sorry, guys, I'm pulling a little comedy here this morning, but I hope you're hanging in there with me. And we can help you do this at passiveinvesting.com. We have our hotels, self-storage, and express car wash deals, as well as our first position lien real estate debt fund. And it has some very unique and powerful statistics on showing you that we can actually help you achieve those financial goals in life for you right now. Now, things that I'm going to go over today, we are going to go over math, okay? This is not financial advice, not legal advice, not tax advice. Consult your team before making any investment decisions. Now, I can already tell you, half of you guys are going to say, Whitney, your math's wrong. And it is. It's wrong for you. This is why I'm going to show you an example of how to put together this math problem for yourself, because each of you are going to build your own portfolio a very different way. But let's first kind of kick it off with principles, okay? And just so you know, if you guys aren't already on my passiveinvesting.com list, join at passiveinvestingwithwhitney.com. Here's a QR code for you to scan. This is the only place you can get my Passive Investing Made Simple ebook, as well as access to my calendar if you want to jump on and talk all things real estate. Okay. Let's do a quick recap of the principles, guys. I have blocked out an hour and a half for you today. And I would imagine we're going to be here for about an hour, but I'm going to hang out with you guys, get your questions answered here at the end. So make sure if you have a question, go to your Q&A box. So your Zoom bar down at the bottom, don't go to the chat box. I will not be looking at the chat box. Make sure you put your question in the Q&A box. That helps me stay organized and get the right questions in the right section of the presentation. If not, I'll clean everything up at the end. And yes, this is being recorded. Not a problem there. You guys will get access to the recording. All right, so we're going to talk about our principles here. Remember, I said there's 4 principles and 3 rules. If you haven't heard me talk about these already, we're going to recap and get everybody on the same page, because it's super important as you put together the math for your plan. Okay, so I love this quote, F.M. Alexander. Okay, I learned this from Gary Keller's book, The One Thing. Okay, Gary Keller and Jay Papasan. This quote is in that book. It's plastered throughout the book, but it is so important. People don't decide their futures. They decide their habits, and their habits decide their futures. And the reason why I love this quote when we're talking about putting together this math for potentially getting you to financial independence or financial freedom, whatever that financial milestone you're trying to hit in 5 years, it's super important because it's going to boil down to what habits you are ready to commit to on a consistent and persistent basis. Guys, investing should be boring. Absolutely boring. You want excitement? Can maybe set aside like a small, $10,000 or whatever, what a certain percentage of your wealth. Have fun with that. Like go invest in like all these like momentum type investments. Have fun there. Have fun on your trips. Have fun with your family. Have fun with your friends. But your investments, they should be consistent, persistent, and boring. Okay. Again, to borrow a baseball analogy from my friends at Left Field Investors, we're aiming for base hits and doubles. If we get the triple and home run, fantastic. But that's not what we're aiming for in our investing. All right. So that's exactly why we should invest based on principle, because if you have these principles in place, these rules that you follow, okay, it's going to keep you in check when you get this awesome investment in front of you. Something that you're just, man, I'm so starry-eyed, I really want to go into this. You're going to run it through your investing principles. You're going to run it through your rules that you created for yourself. Remember last time, our last boot camp, we talked about tracking your portfolio. And I challenged everybody here, when you track your portfolio, create rules for yourself on how you're going to allocate your portfolio, who you're going to invest with, where you're going to invest, and what type of investment you're going to go into. Okay. Now, don't share other people's rules because they probably don't have the same goals as you do. Okay. So decide this now when you're in a calm, cool, collected state. That way, when you get excited by a deal in front of you and you're pressured to put in your commitment and get to the legal documents, you can go back to your rules, back to your principles, and you can methodically check through them and make a very educated decision. Again, those rules will keep you from making rash decisions. They'll help you hedge against risk. And quite honestly, when you invest based on principles, following these 4 principles and 3 rules, you're going to make money whether the market goes up, down, or sideways. Okay. Now, I don't say that as an absolute. Okay. I should say potentially make money whether the market goes up, down, or sideways. But because you have, 7 ways of creating wealth, okay, and protecting your wealth and hedging risk, okay, it's much more likely that you will make money with that in that investment. Okay. So what are our 4 principles here? Number 1, capital preservation. Number 2, cash flow. Number 3, equity growth and levers. Number 4, tax benefits. And then we're going to talk about our 3 rules. Okay. Now, again, I spend quite a bit of time in our goal setting boot camp, okay, which I'll repeat here in a couple months, hammering home these principles. But I'm going to go through these really quickly so we can get to the math. All right. So why capital preservation? We got our good friend here, Warren Buffett. Rule number 1, don't lose money. Rule number 2, see rule number 1. Okay. The whole point is to not get knocked out of the game. Okay. If you lose your capital, if you lose your initial investment, you're closer to getting knocked out of the game. That's the whole point. Okay. I'm going to sum it up like that. So there are some points here on the screen to follow to not get knocked out of the game. Okay. We want to make sure we're in great growth markets. We want to make sure the asset has ample reserves behind it. And more importantly, we want to know where those reserves are invested. Now, I've been kind of hammering this home with investors for the past year, even more relevant today, given to where, and I don't want to hound on SVB and the kind of rumblings we've seen in the banking system in the last couple of weeks, but that is a very valid question. Where are those reserves invested? Either being held or where they are invested. Okay, you want to know that. Okay, you want to make sure those reserves are on solid footing. Okay, you don't want to invest in the best asset in the top asset, the top dog in the market, right? We want to see sales comps higher than the subject property, so we have room to move in the market, and we want to make sure that there's a clear exit strategy with contingencies. Okay, you might have a plan A, but what's plan B, plan C? Okay, how else can that operator help preserve capital and asset? All right, number 2, cash flow. Okay, we want to be able to pick multiple apples off that tree and make money, not just have to wait for 100 years and then chop down the tree and make money one time. We want to see that consistent cash flow coming in. I would like to see that cash flow starting today. Okay, being able to cover the expenses on the property. If it's cash flowing today with today's interest rates and today's cap rate fees, that we're on sounder footing, because as rates plateau and maybe even come down here over the next year and a half, we're going to have a chance to refinance on those properties and get them into a better cash flow position. All right. So we want to make sure that there is a good, solid business plan and that the asset cash flows today. Okay. We also want to look at the business plan going forward. Okay. What is the income growth, expense growth, vacancy? Again, we're looking on the returns where we want to make sure that there's conservative returns on cash on cash. Gone are the days where operators are overfunding and over raising on the deals and using that to pad year 1 and year 2 cash flows. We want to make sure, hopefully that practice is now out of the private equity system. Hopefully. Unfortunately, I still see operators doing that every once in a while, but we want to make sure those year 1, year 2 cash flows are very conservative and consistent with a business plan that is stabilizing an asset and growing an asset. All right, we want to make sure that there's a low break-even occupancy on that asset, be it multifamily or self-storage, whatever you're investing into. If you're investing in a business, we want to see low operational expenditures. We want to make sure that if income drops to a historic low on that asset, that it still can pay all the bills. All right. Now remember, limited partners, we're not a bill, we're partners in the asset. We're not a bill, we're not a line on the profit and loss statement. We want to make sure all those bills are being covered so we ourselves aren't seeing capital calls. All right. We want to make sure that rental comps are higher than the subject property. And I like to see the distribution schedule either monthly or quarterly. Okay, I want to make sure that that cash flow is able to come in on a consistent basis. Whereas, if there's an asset that distributes biannually or just annually, it tells me I might be scratching my chin here thinking that the cash flow is so variable and volatile throughout the year that that's the only time that the operator can distribute is when they see throughout the entire year what cash flow is going to be like. All right, sorry guys, skip number 3, very important, okay, for our pillars here. We want to make sure we're going to assets that have good equity positions, okay, that we have a solid business plan to increase income, decrease expenses, add additional streams of income. We're looking at sales comps higher than the property. We have a good sensitivity analysis. We have good waterfalls and reasonable fees on the asset. We want to make sure that asset has amazing tax benefits with it, okay? Depreciation. If you guys saw my article about 2 months ago in the passiveinvesting.com newsletter, if you aren't getting that physical newsletter, drop your email in the Q&A box with your address. Drop your email and your address. I will download the chat. I will match those up and make sure you're getting that via mail. But we want to make sure that we are using depreciation to accelerate the time value of money. Okay, if you can arrange your affairs as such that you're paying the tax bill that you need to or required to, not that you feel like you should, but that you're required to by law. Now you can take that extra savings and plow that back in to your numbers, to your investment. Very important for your 5-year plan. And I don't have a tax line item in my plan, but I want to show you what would happen if you did. Okay. So very important here, very important that we're trying to do everything we can to lower our number 1 expense for our investing. Okay. So we've gone through the 4 principles. Now I want to go through the 3 rules really quick so we can get to some of these numbers. So 1, we want to see the smart use of leverage. Okay. Very important to today's environment. Who's lending on the project? Is it public lender, private lender? What are all the loan terms? We want to get very specific on that. I like seeing 70%, or lower potentially on loan to value. We're seeing that a lot more these days as banks and lenders are hedging risk should the market soften a little bit. I'd like to see fixed rate debt or a floating rate with a rate cap on it. Now, guys, if you do the math, for those of you who are super into underwriting, okay, underwriting is not for the faint of heart. Most of you guys, if you're super into underwriting, you will realize that floating rate debt is still less expensive than fixed rate debt. Okay, and that's because of the prepayment penalties or the yield maintenance on these loans. Okay, so I would still expect to see some floating rate debt, but make sure that it has a cap and that the business plan is sound and solid in order to avoid paying for a future cap on that loan. Okay, We want to see the ability, if it's a fixed rate debt, we want to make sure that the IO term, the interest only terms, are for at least the time of the hold, if not a little bit longer. If it's a floating rate debt term, we want to make sure that there's extensions available to us. And again, we want to make sure that, taking into account with all of this debt, that and any fees and escrows associated with that debt, that there's still good numbers, a good break even or operational expenditure break even point on the asset. Okay, I can't drive home the debt portion enough. All right. I know a few of you guys are wanting our email, and you've dropped in, or excuse me, our newsletter, and you've dropped in only your email. I need your email and your address because I can't mail you the newsletter with only the email. I need your address too. Okay. So we've talked about inflation hedging a lot. Essentially, that ties back to pillar or rule number 5. We want to have good rate. We want to be able to lock that in and let time erode the value of that loan. Also, we want to have a good business plan in place so we can pass through income increases to the customer, as well as expense increases to the customer. And we want to be able to adjust those often to respond to what we're seeing in the environment. Okay, very important. All right. Now, number 7. I'm going to hold on to number 7 here in a little bit. Okay, pillar number 7, which is rule. Rule number 3. Guys, if you're dropping things in the chat, I'm not going to be able to hold on to those. Make sure you put it into the Q&A box. Don't put your private information into the chat. Okay. All right. So now let's talk about the math. Now I'm going to just kind of paint a picture, and then I'm going to show you a spreadsheet. Okay. To where, if you were going to put this together, you can, kind of see, oh, this is what I might need to do for my own personal situation to get to my level of financial independence, financial security before, in X timeline, okay? Whatever that timeline is to you. Now, it's attractive to get it done in 5 years, okay? But maybe it takes you 7, maybe it takes you 10, okay? Maybe you have a wealth to invest right now, and you can do it in 3. Who knows? All right. So the first thing here is you actually have to fully understand your goals. So what is the milestone of your financial journey that you're trying to hit? Okay. So you want to take that into account when you're building out your numbers plan. Now, you guys were probably attracted to come here because you were like, Whitney's going to show me how to do this in 5 years. Get totally 100% financial independent in 5 years. That may be realistic for you. It may not. Okay. Maybe you're just like, wow, I don't have this much to invest. All right. Or you're like, I have more. Okay. But be realistic about which milestone you're trying to hit, and be consistent. Take the actions consistent and persistently to that milestone. And I want to tell you guys, even if you think it's going to take, say, 3 years to reach financial security for yourself through passive investing, eventually you're going to get hockey stick growth if you continue to stay consistent with your boring investment plan. Okay. All right. Again, you have to understand your timeline. Now, here's the most important thing that I want to drive home here. When I show you this math, I'm going to show you it in a conservative manner, as if you're investing in your standard multifamily deal today. Now, obviously, if you start manipulating numbers and trying to chase yield, higher percent, pref distribution or whatever, yeah, you might get to your goal quicker. But what kind of risk are you taking on to hit that timeline? All right. What kind of risk are you taking on to hit that timeline? All right, so I'm going to kind of paint this picture. This is somebody, who's just getting started, okay? And they're looking to, invest in deals that have a 7% prof and a 2x equity multiple on their deal. And let's say they have $350,000 to invest right now. I'm going to show you a couple of different scenarios. Year 1, they would invest, maybe they have $350,000, cash set aside. And I know on these masterclass webinars, we have accredited and sophisticated investors. That may be you, may not be you. Majority of our accredited investors have on average $500,000 to $750,000 in liquid cash ready to invest. So that's why I try to choose some larger numbers to show you if you can front load this investment, you're going to get there faster. But year one, they invest $350K. Now, from a cash flow perspective, if they can hit the 7% prof year one, they're going to hit, about 24,500 in cash flow. For some people, that is like amazing. And for other people, they're just like 24,000, like I need way more than that to live off of. Okay, guys, initial investment year one. But if you consistently and persistently continue to invest $100,000 each year for 5 years, by the end of 5 years, with none of those assets repositioning, just the cash flow alone, you'd be at 52,500. Okay, as you can see, you start picking up some accelerated growth here when these assets start repositioning in year 6. Okay, again, may not feel like light years right now. You're just kind of like, oh, okay, maybe not. This might work for me. But let me pause real fast here. I'm going to flip over to my spreadsheet that I wanted to show you. All right, guys, bear with me. Tech works until it doesn't. All right. I can't seem to exit out of here, and I feel like I've lost you guys. I'm so sorry. Okay. Woo, okay, I'm out of my spreadsheet yet. I'm out, I'm back, I'm almost there. Thank you for hanging with me. Woo, that was, my screen froze there. If anybody has a Mac, that spinning wheel of death that you Mac death that you get sometimes. Anyways, you're just like, oh my gosh, where'd they go? Okay, so here is just kind of like an example now of a couple different ways. Now, in this particular example, I had this person actually pre-funding about $500,000, kind of like one of our typical uncredited investors. Now, guys, it doesn't matter. You can be ahead or behind. You need to sit down and understand the math. So, the first year they put $100,000, they're going to get, 7% preferred return. They're going to get 35,000. Okay. And then each year they just continue to contribute $100,000 to this plan. By the end of year 5, they're yielding, they've got almost, total invested, and I'll tell you why this is over $1 million, but they're bringing in $76,000 in cash flow. Now, this is why I say investing plans are so individual, right? Because this person actually is, if you see here, they are reinvesting all of their cash distributions to bolster up their cash position for 5 years. So they have $900,000 invested, cash invested, but because they've been harvesting their cash flow, they actually have almost 1.1 million in there, tax-free, because they've been, those distributions are being offset by the depreciation on the asset. Okay, the income's being offset by the depreciation. So they already have 10% growth there, just almost 11% growth, just by taking their cash and plowing it right back into their investing plan. So they're at 76,000. No assets have repositioned here yet. But in year 5, assets start repositioning, okay? And so their first year, that, the $500,000 that they invested, now they're going to get profits of $325,000 to reinvest back into the deal. And let's say they do a 1031 exchange. Again, all that 325 moves forward tax deferred. So they're not paying any taxes on that asset. It's not eroding. They're not losing 20% or more towards capital gains. And they continue again, they're boring, just 7% preferred return, okay? Now here, they start pulling their cash flow at year 6, Okay, but maybe they're still working their day job and they're able to continue to put in $100,000 because they're like, my family could live off of $106,000 cash flow, but I want some extra padding. I want to know that in another 5 years that I can do whatever I want with whomever I want. Okay. And then now they've got $200,000 in 5 more years coming in after all their assets reposition. They continue to they're not reinvesting any of their cash flow. They're actually consuming it at this point in time. Okay, they're living off the cash flow, but they're reinvesting their gains tax-free. Okay, so they could at any point in time here for their plan, they don't have to walk away. I mean, they could walk away if they wanted to, right? But again, this is different. Maybe you only have $350,000 to invest. Okay, your numbers would change. But again, if you can continue in the first 5 years to reinvest all your cash flow into your plan, you're going to get closer. You're going to get so much closer faster. All right. Now, maybe, I put $350. That's not good. Let's do $350,000. That looks better. Okay. Now, maybe you're like, Whitney, I don't want to reinvest my cash flow. I actually just want to live off my cash flow from day one. Again, this is your path. You can turn around and back out reinvesting that cash flow. Okay. And you can see your numbers move a little bit. Okay. You're not, you've probably taken a couple years off of your investing plan initially. Okay. You've slowed your growth a little bit, but maybe you're taking a better glide path, right? This is where it becomes so individualistic. But the drive home point here for you is that you need to put together a plan, an idea, a sketch of how much could you kind of preload into your plan. Now, you don't have to do it all in 1 year. Maybe you had $500,000 to invest, but you wanted to break it up over the first 2 years of investing. Okay, you're just like, man, I don't want to go into everything in this market right now. Okay, you can do that too. All right. So this is where we encourage you, or I encourage you, to put together a spreadsheet similar to this and understand how much can you continue to allocate, take off the table from your active income and put it into an environment to where you can now accelerate growth over the next 5 years and take advantage of accelerated depreciation. Especially, we still have bonus depreciation, happening right now. It's 80% this year, 60% next year. It'll start ticking down, right? So this is where it becomes really individualistic. All right, I'm going to take a quick gander. Somebody asked, Terry, you asked, do I reinvest the initial 500K? So if we go back to our original scenario, let me set that back up really fast. I assumed that the initial 500,000 gets reinvested in year 6. Okay. And just the profit from the sale. Okay. And this is actually, the initial 500,000 is getting reinvested. It's still in this number right here. Yeah. But when you see reinvestment right here, that's the profit on the 300 or the initial 500,000. Awesome. Okay. So I would love to know what questions come up for you guys on this. Like, as you're thinking through your plan, what are your number one obstacles with visualizing? Because math doesn't lie. This works. But it is boring, and you have to be consistent and persistent about it. Now that you know that the math works to get you to some sort of whatever your financial, milestone you're trying to hit, okay, what is your obstacle for execution? Okay. And so I really love centering back to 3 questions. What do I want? Why do I want it? And then who do I have to become to get it? This math, I am very analytical minded. I love spreadsheets. I love math. If I can visualize, I visualize in numbers. If I can visualize it in numbers, then it becomes down to, okay, now what do I need to do next? What are my steps that I need to take? And then that's when all the kind of like internal things come up, like, and I have to now answer the question, who do I have to become in order to get this, to achieve this plan? Right? All right, I'm going to flip back to my presentation. We've just got a couple additional slides to go over, and then we can open up the floor a little bit. Take two, try this again. All right. So we took a look at a couple different scenarios of what people were able to initially invest in. This last scenario that I left with, or the first scenario on the spreadsheet, I was showing somebody who had a large initial investment and was reinvesting their cash as quickly as they possibly could, okay, and where they were at in 5 years. Imagine that in another 5 years, they were over double where they're at. Here, this person's actually consuming their cash flow, but they're still making good progress towards their goals. But I promise you there was 3 rules to follow. Okay. And the third rule is you have to invest with experts. All right. Going back to rule number 1, it's cyclical, capital preservation. The number 1 rule that you have to follow is to not get knocked out of the game. And to not get knocked out of the game requires that you understand your goals, your risk tolerance and timeline, and that you invest with experts who know how to execute this business plan. Okay. They've got the knowledge, they got the strategy, they got the team, they have the ability to secure credit and lending. They can reliably pool investor capital and close on assets. And they are watching out for you. That is super, super important. All right, guys. As I promised you, this was going to be a short kind of presentation, walking you guys through the math. For those of you who are here live, feel free to stick here. I'm going to continue to do question and answer. If you're joining on your favorite podcast player of choice, guys, have a fantastic day. All right. So question came in, is the 7% guaranteed? Guys, the 7% pref is preferred return is not a return at all. I wish we could come up with a different way of saying it. It is and isn't a return. It is the first 7% of the deal goes to the investor. Okay. So in an ideal world, you're harvesting that in through cash flow on an annual basis. But again, everything, not all deals are created equal, right? And especially in this market, we're seeing some cap rate compression, we're seeing cash flow compression. And I just really want people to encourage you not to chase yield just to get a return. Okay, we want to keep that very, very conservative. Now, the question is it guaranteed? No, nothing is guaranteed in this world. But when it's a pref return, I know this is how we put it in our PPMs. The first 7% of that deal, on our multifamily, on our self-storage goes to the investor. Whether it's cash flow, capital gains, however we get it to you, the first 7% goes to the investor. We're not inserting ourselves in what we call a GP catch-up capacity in there. Yes, this is being recorded. The next question, is this being recorded? Yes, it is. All of my presentations are recorded. This one will be posted on YouTube later.